Every year, more and more people decide to invest their funds in this digital market, hoping for quick profits. According to research by Henley and Partners, in 2024, the number of people owning crypto assets worth more than $1 million reached 172,300 people, which is 95% more than the previous year. In this video, we will analyze the most common mistakes made by novice cryptocurrency investors, as well as tell you about the loudest and most interesting cases of fraud so that you can avoid them and protect your funds. Subscribe to the Blockoria channel so you don't miss new videos. You're watching the Blockoria channel, where we make the complex understandable with analogies and examples. We appreciate your time. Subscribe so you don't miss out on new helpful videos. Emotional investments. Following the herd. One of the most popular scenarios is buying cryptocurrency at the peak of its growth, when everyone around is talking about a new gold mine. Amid the hype, many novice investors buy tokens without proper analysis, acting on the principle everyone is doing it, so I shouldn't miss out on the chance either. This behavior is often called FOMO in the community. This is the fear of missing out. This term describes a psychological state when a person is afraid that he is missing out on potential profits from a rapidly growing cryptocurrency or project. How does FOMO manifest itself in cryptocurrency? Buying at the peak of growth. When the price of a cryptocurrency rises sharply, investors give in to an emotional impulse and buy the asset, fearing that its value will continue to increase. This often leads to buying at the maximum, after which a correction or fall may occur. Impulsive decisions. Fear of missing out on profits prevents investors from conducting research on a project or market. As a result, they invest in little-known or questionable tokens that may turn out to be a scam or simply depreciate. Ignoring risks. In a state of FOMO, people tend to ignore volatility and long-term risks, focusing only on the current growth. Example of a FOMO situation. You see that the price of Bitcoin has risen sharply in a week from $30,000 to $40,000. The news and social media are full of discussions about this growth. Succumbing to the fear of missing out, you buy Bitcoin, but a few days later the price drops to $35,000 due to a market correction. How to avoid FOMO. Do your own research, the DYOR. Instead of following the crowd, study the project, its prospects, the team, and the market conditions. Create an investment plan. Set rules for buying and selling assets so that decisions are based on strategy, not emotion. Take your time. The cryptocurrency market has been around for over 10 years, and opportunities to make money appear regularly. The best deal is not always the one that happens right now. Lack of portfolio diversification. Many newbies, upon hearing about a successful project, invest all their funds in one cryptocurrency, expecting instant profits. This can be very risky, especially if the project runs into problems or regulations change. Imagine going on a long trip and taking only one type of food, for example, apples. If the apples go bad, you will have nothing left to sustain yourself. However, if you took different products, bread, nuts, canned goods, then even if one part of the supply spoils, you will still have an alternative. If one asset shows poor results, others can compensate for the losses. Ignoring security. Many newbies do not pay enough attention to the security of their funds, choosing unreliable wallets or exchanges. As a result, they often become victims of hacker attacks or fraud. Use reliable wallets with two-factor authentication, such as hardware wallets. Never share your private keys, keep them in a safe place, and do not trust unfamiliar sites. In our videos, we have already talked about what wallets there are and how to use them. Watch this video if you want to be safe. Underestimating the risk of volatility. Many novice investors hope that cryptocurrency will grow steadily, forgetting about its high volatility. The rate can change by tens of % in a few hours, which leads to a loss of funds if you do not take this factor into account. Imagine that you are climbing the mountains. It can be sunny and calm in the morning, a strong wind will rise in an hour, and after a while it will start to rain or snow. The weather changes quickly and unpredictably, sometimes hot, sometimes cold. The same is with cryptocurrency prices. Sunny weather, the price is stable or rising. Wind and rain, the price drops sharply or jumps up and down. Sometimes it seems that everything is under control, but suddenly there is a sharp change that is difficult to predict. Monitor the market regularly and do not risk funds that you are not prepared to lose. Ignoring scams and fake projects. In search of quick money, some beginning investors fall victim to scammers who offer them incredibly profitable schemes or projects with high returns. Often these turn out to be scams or pyramid schemes. Check the projects and companies you are going to work with. Pay attention to reviews, technical support, as well as the presence of licenses and regulation. Avoid too good offers that seem unrealistic. High-profile cryptocurrency fraud cases. Unfortunately, the cryptocurrency market is not immune to fraud. There are several high-profile cases in the history of crypto that have become a lesson for many investors. BitConnect. One of the most famous examples of a cryptocurrency pyramid scheme. BitConnect promised its users a guaranteed income and even offered its own cryptocurrency, which grew in value after a while. Soon the project was shut down and thousands of investors lost their money. Plus Token, a cryptocurrency investment platform that promised users high income. However, it turned out to be a classic Ponzi scheme. As a result, 2 million users lost over $3 billion. The platform closed down and its creators ran away with the money. OneCoin. One of the most famous cases of fraud, which became a global financial scheme that defrauded tens of thousands of people. OneCoin sold non-existent cryptocurrency, and its founders are still on the run. Squid Game Token, a cryptocurrency that gained popularity after the release of the TV series Squid Game. However, soon after its sharp growth, its price collapsed, and the developers cut off the money, leaving investors with empty wallets. This became another proof of how easy it is to fall for scammers if you are not careful. Remember these simple but important rules. Research the project. Before investing, scrutinize the project, its team, and goals. Look for information in independent sources and forums. Don't trust promises of high returns. If someone promises you a guaranteed profit, it should be a signal of fraud. Check licenses and regulations. Make sure that the project is operating within legal regulations and has the necessary licenses. Don't follow the herd. If everyone around you is saying it's the new Bitcoin, think about it. If it were, why would people share such a secret? Cryptocurrency is a huge potential, but it's also high risk. To avoid mistakes and protect your investment, it's important to exercise caution, not rely on emotions, and always do your due diligence before investing. Remember that there are both opportunities and pitfalls in the world of cryptocurrencies, and only a balanced approach will help you avoid losses. If you found this helpful, subscribe to Blockoria, share this video with friends, and leave your questions in the comments. See you in the next video. Thank you for watching Blockoria. Our goal is to make the world of cryptocurrencies easier to understand in order to accelerate its development. With your support, we will be able to create new high-quality videos, making crypto education accessible to everyone. If you like our project, support us by donating. It's an investment in your knowledge, and the world of the future will be better. We're happy to share our partners' referral links with you. By using these links, you may receive bonuses, prizes, and commission discounts.